Welcome back to another video, everyone. In this video, I'm going to show you how to master candlestick patterns. So we are going to go over the breakdown of candlestick patterns, how to trade candlestick patterns versus formations, and the different types of candle formations. So let's get started. So first and foremost, what are candlestick patterns? Candlestick patterns are price formations on a chart that showcase us who has control of price. Are bulls in control? Are bears in control? Or is anyone even in control? So when we look at these candlestick patterns or candle formations, we're able to identify the strength behind price. Now, I want you guys to think about something for a second before we jump more into candlestick patterns, right? Now, this right here is one of the candlestick patterns that we are going to go over. Right? This is a candlestick pattern that means that the price will go up. So basically, when you see this pattern, what it identifies is that the price is going to go up. Hey, I see this bullish engulfing pattern, I should buy. That's the typical mentality most people have behind patterns. Now, what I want you to understand and what we're going to take away is we don't care about patterns. We're not going to trade strictly off patterns. We're going to get a deeper understanding of every pattern and price formation. So think about it. If we just see a pattern, if we see this bullish engulfing pattern, do you think this automatically means that the stock's price will go up? Yes or no? The answer is obviously no. Just because you see a candlestick pattern does not mean that a stock is going to go up, down, sideways, whatever. A candlestick pattern itself is not going to show you that, because think about it. If candlestick patterns work 100% or they did work every time you've seen them, don't you think everyone would make money? It's simple. They don't work all the time because people don't know how to properly use them. So I'll show you how to properly use them in a bit. Now, this is the number one mistake traders make with candlestick patterns. Trading candlestick patterns in isolation. So what tends to happen is they see a candlestick pattern, they get super excited, and they're like, yes, I found the pattern. All right, I'm going to take on the trade. They find the pattern, they take the trade place, and boom, it doesn't work out. Right? So once again, the biggest mistake people make is trading candlestick patterns in isolation, meaning just looking at a single candlestick and trading based off that. That does not work. So if you have learned candlesticks in the past, throw everything out and I'll show you how to properly trade them. And when you do trade them, keep this in mind. Do not trade them in isolation. The same goes for chart patterns. The same goes for any pattern that exists. Do not ever trade them in isolation. You have to look at other factors, right? Now, another thing I want you to know is candlestick patterns are basically traps for retail traders. Why are they traps? Because we are pattern recognition machines. So if we see a pattern right off the bat, our brain says, oh, I see pattern XYZ. Pattern XYZ means that the stock is going to go up. So that means I should buy. What tends to happen is nowadays with a lot of computerized systems, algos and all that set up, these computerized systems are trapping us retail traders with these patterns, right? And that's why if you have traded with just candlestick patterns, you probably haven't seen much success, because trading them in isolation and not understanding the context behind them is going to set you up for a trap itself. So we want to avoid that. We don't want to trade candlestick patterns themselves. We want to understand the meaning behind them and trade them the proper way, right? So the question is, how do we trade candlestick patterns? We don't trade patterns, we trade candle formations. Our job is to understand price action on a deeper level so we can distinguish between strong and weak candle formations. So what we're not going to do is we're not going to sit here and memorize all the patterns. We're not going to say this is an engulfing pattern, this is a doji pattern. We're not going to memorize. I don't want you guys to memorize patterns. I want you to understand the meaning behind each and every single pattern that we go over and understand, does this mean that the stock's going to go up? Does this mean that the stock's going to go down? Why and why and why? And I want you to question it. I want you to have a deeper understanding instead of just recognizing patterns and trading solely off that. So now, How do we trade candlestick patterns, or how do we trade candlestick price formations? First and foremost, you see a candlestick signal or formation spotted. So you're looking at your chart and you see a candlestick, right? Now what most people do, like I mentioned, they see a candlestick or they see a candle formation and they go right away and they're like, all right, buy. All right, sell. No, that's not what we're doing. If you do that, you're missing out a bunch of different steps, right? If you see a candlestick pattern or if you see a candle formation, do not jump the gun and take on a trade. Take a step back. Now, when you take a step back, these are the steps. The first step is check the candlestick signal quality factors, right? Is there volume? Is it at a critical support level, critical resistance level? You need to check these things out, right? These are very, very important in playing candle formations or candlestick patterns. Same exact thing. Check higher time frames to see if there's synergy in the trade idea. Remember, multiple time frame analysis. Do not trade strictly off one time frame. Check other time frames. Confirm your trade. The higher confirmations you have, the more confirmations you have, the higher the probability you will have on the trade working in your favor. After you check that, evaluate market structure to see if the trade idea fits current context. You have to look at the market structure. You have to look at is the market selling off? Is the market going up? What is happening with the market? What is happening with the stock? There's a lot of things to consider before you solely trade off just a candlestick, right? And like I said, we're not trading just off a pattern. We have to look at other factors. And I will walk you through a few examples of showing you this happening live. And then once this is done and everything comes together and makes sense, you then plan the trade, commit to the trading plan. Know where you're buying, know where you're exiting if you're wrong, you know where your profit take area is. All these things come around, and once that happens, boom, trade plays. And yes, this looks like it's a lot, but I promise as you progress, these become like second nature to you. You start having a very great idea on when I'm going to buy, when I'm going to sell, and these things you don't really think about over and over again. It just comes to you naturally, right? So in the beginning, it's going to be a lot. You're going to be like, oh, am I looking at everything? Did I miss something? What else do I have to look at? But as you progress and as you put in more screen time, I promise this thing it's just going to kick to you like second nature. Now, questions to ask during candle formation. Now, if you see a candlestick pattern, or if you see certain formation that's showing you that the stock's going to go up or down, these are the questions you need to ask, right? So every time you look at a candlestick, ask yourself these questions. Every time you see a pattern or a formation that's giving you a buy or sell signal, what is the story here, right? I see a pattern that's showcasing that this stock is probably gonna go up. Why is it gonna go up? What's the moving factor behind it? Did they come out with good news? Is there bad news? Is the market rallying? What is the situation with the stock? These things have to be asked, right? Next, are the bears or bulls in control, or are they even? What is the candle even telling me? Is the candle telling me that bears are in control? Remember, bears want the stock to go down. Are bulls in control? They want the stock to go up. Or is anyone even in control? Sometimes you'll see in price, no one has control. Bulls and bears are just fighting. Sometimes bulls have more control, and sometimes bears have more control. So looking at the candle, that's another thing you should ask yourself. Another thing you should ask yourself is, where is this candlestick forming in relation to significant price levels like support and resistance levels? For example, is this candle forming at a support level, right? Is this candle forming at a resistance point? Where is it forming, right? This context has to be applied, where you have to understand, is it forming at a critical level? Is it on an uptrend? Is it on a downtrend? What's happening with the market? What is the story here? All these things have to be asked. And obviously, once you get into the rhythm of the market and start understanding things and start applying yourself and you gain more and more experience, these things come to you like second nature, right? So I'll give you guys an example, right? Let's say we have a candlestick example, but before we jump into the candlestick, the first thing we look at market context. We see that the market is selling off. So let's say today is Monday, right? Monday, the overall market, right, is selling off because let's say we're going into a trade war with China, and the trade war is escalating, it's heating up. There's a huge fear of, let's say, global recession, that the market is going to fall, and the overall market is selling off very, very aggressively. So today on Monday, the overall market is selling off. Everything looks bad. All right. Next, let's just say in the past 2 weeks, or in the past week, or even today, the company is also surrounded by a lot of negative news. The company is getting sued. Company ABC is getting sued. They have a lot of negative sentiment, a lot of negative news surrounding them. Now, when we go to the chart, we're like, all right, let's go look at the chart, because the market is selling off. There's a lot of negative news. And when we go to the chart, we actually see a bullish candle formation. So, once again, the market is selling off. The company has negative news, negative sentiment. Everything with the company is negative. But we look at the candle formation on the chart, and what we see is we see something like this. Let's say the stock is selling off, and it gives us this candle formation. This candle formation, which I'll cover in a bit, this represents that the stock price will go up. This is a bullish engulfing pattern. I'll show you this in a bit. I'm going to go over it. This is showcasing that the price is going to go up. So what this means is, if you see this pattern, this means that the stock price is going to go up. Now, the question that I have for you is, would you take this trade knowing that the market is selling off, the company is surrounded by negative news, but when you look at price action, when you look at the chart, you see a bullish candle formation? Are you going to trade this? Are you going to buy this? Right? And think about that. Right? Now, if you are thinking about it, would you trade the stock? Would you buy? Whatever the case is, the proper answer should be no. No, you should not take this type of trade. This is a very low probability trade. Why? Because the market is selling off. The company is surrounded by negative news. I don't care about this candle formation, right? This candle formation might do something like this. It might make the price go up for a little bit and then continue selling off. That's why knowing the market context, that's why looking at other clues and other things that the market is showing you is very important in trading candlestick patterns. It's very important in trading candlestick formation or price action itself. You need to understand the following things in order for you to take on a very high probability trade. And this is one thing that a lot of people mess up on. And that even if this does show me a candle formation that means that the stock's price is going to go up, I'm not comfortable in trading this today. Now, if this was flipped and the market is, going up and it looks pretty healthy today, or for the past week or two, there's no negative news, or let's say they came out with good news and I get a good candle formation, now I have a higher probability on taking this trade, right? That's one thing you need to keep in mind. So we are not trading strictly of candle formations. We need to understand market context, company news. You need to ask yourself questions. Is it at a critical level? Is it at support? Is it at resistance? Is the stock trending up, down? Everything we went over in price action. You need to apply those and get very, very good at that in order for you to understand price action and candles on a deeper level. Now, let's jump into the patterns. I'm going to go over some patterns and we're going to break them down. Now, what I want you to understand is there's over 100 different candlestick patterns that exist. There's a lot of different names, a lot of different candlestick patterns. So instead of memorizing the names, let's understand the meaning behind the formations. So I want you guys to understand the meaning behind the formations. I want you to understand what each pattern means. Does it mean bulls are in control? Does it mean bears are in control? Why does it mean bulls are in control? Why does it mean bears are in control? Is anyone even in control? So I want you to understand the formations instead of trying to remember each pattern. Okay? So let's jump to the patterns. Now, these are the following patterns that I'm going to break down. We have the doji, we have a spinning top, we have a pin bar, engulfing pattern, and an outside bar, right? These are like the 5 I'm going to focus on. There's a bunch of them, but you'll see all of the patterns that you've probably learned in the past, or you've seen, or you've read about. They all mean the same thing. They all fall under the same categories, right? So the first pattern that we have is called a doji pattern. This is what a doji pattern looks like. Now this is a candlestick where its closing and opening price are almost, keyword, almost the same. Doji is a neutral and indecision candle. When you look at this, it showcases that no one is in control of price. Bulls are not in control, bears are not in control. No one is in control of the price when you look at this doji candle. Now, like I said, we don't care about the name. I don't want you to go and start trying to remember the name, because knowing the names is not going to help you. But if you can just ignore the name and just look at price action, just looking at this candle, you see a candle like this. This means no one is in control, right? Why does it mean no one is in control? Because price opened here, right? This is where price opened, went down, went up, and closed around the same level it opened. So bulls and bears went at it with one another, but no one was able to have control over price. This is a doji candle. Once again, it's neutral. It means no one is in control. So if you see a doji, let's say you're looking at a chart and you see a doji at a certain level, that means either the stock is taking a break or no one is in control. So I would wait for the next candle to take on a trade. Right? And I'll show you how to trade them in a bit too. Now, these are the types of doji patterns. Right? There's a bunch of different names. We have a doji, we have a long leg doji, gravestone doji, dragonfly doji. But let's do something real quick. Right? Obviously, I can't just give you random candlestick patterns without names. But for now, forget the names. I don't want you guys to think about the names. Names don't matter. Names are not going to help you make money. Names are not going to help you make high probability trades. Understanding the patterns are. So in the first one right here, let's call this number 1, number 2, number 3, and number 4. And number 1, who is in control? Right? If you look at it, price opened here, went up, bears rejected, bulls brought it up. Who is in control? No one. It's neutral. Same thing here. Who is in control? This is the same thing as this one. It's the same thing as number 1. The only thing is price was a little bit more volatile. There was more price action. The price moved much more compared to number 1. That's the only difference with 1 and 2. In 1, price didn't really fluctuate much. In 2, price fluctuated a lot. Bulls and bears fought a lot, but no one is still in control, right? Now, let's go to number 3. What happened in number 3? Who is more in control? What is the story behind number 3? Now, the story behind number 3 is a little bit different. If you look at number 3 and you understand price action, this is what happened. The stock opened here. Let's say it opened at $10, right? It opened at 10, and throughout the time period, the stock went to a higher point. Let's say it went to 11 throughout that time period. It went to $11. So what happened is bulls were obviously in control. Why? Because for a stock to go up, bulls have to have more control. Bulls drove it up, and then what happened right after? Bears drove it right back and said, nope, we are rejecting the price. So in this situation, yes, this doji represents that bulls and bears are a little indecisive, but bears have a little bit more control here, right? They have a little bit more control. Why? Because if you look at 1 and 2, right? In 1 and 2, this is what you see. In 1, you see bulls brought it up. They had this much control, and bears brought it down. They had this much control. So it's pretty equal between bulls and bears. But in this situation, bulls brought it up. This gets eliminated because bears were the ones that actually had the last control in price. Now, if there was something like this that existed, it went down and then back up, then bulls would be equal. But here, bears have a little bit more control because they were able to reject the stock price. So think about this now, right? Think about seeing this doji pattern, right? A stock is going on an uptrend. There's resistance, and you see this doji pattern. What is that telling you? That's telling you that bulls try to get it above this level, and boom, got rejected. Who rejected it? Bears rejected it. Bears have a little bit more control, and that's where, if we look at the next candle, and it's a continuation red candle, obviously high volume and other things we want to look at, that means bears have now taken control. Now, if you flip to the fourth one, Dragonfly Doji, once again, the names we don't care about. What's this mean? This means bears, this means a stock opened here, bears brought it down here, and then throughout the day or throughout the period of the candle, bulls brought it back up. So bulls have this much control. This shows that the bulls are a little bit more stronger. Now, does this mean you should buy? Does this mean you should short? No. This is just one concept. This is just showing you what is happening, right? So if you see this, this means that bulls are stepping in. So for example, if let's say we have a support level, and around that support level, you constantly keep seeing this right here. What is that telling you? That's telling you that at this point, there's a lot of rejection. Buyers keep stepping in, buyers keep stepping in, buyers keep stepping in, buyers keep stepping in, that there is a lot of demand here. Every time the price goes down here, buyers are aggressively stepping in, which is a good sign. Now, if this can show us buying pressure, it can show us a strong green candle, increased volume with obviously other contexts that we're going to look at. This would give us an extremely high probability that this may go higher, right? Now, another one we have, it's called spinning top. This is very similar to a doji pattern if you guys look at this. It's a candlestick where its closing and opening price are near each other. This showcases that no one is in control of price despite the body being red or green. The body can be red or green, it doesn't mean anything. It still means no one is in control. This has very long wicks. These are the wicks, once again. Very long wicks, and the body is in the middle, and the body is usually small. Now, when you look at this one right here, let's look at number one. And let's call this number two. Number one, who do you think has more control? Bulls or bears? Right? Think about that. Who has more control? Bulls or bears? Their answer is no one. No one has more control, right? It's neutral. This is neutral. No one has more control. It is neutral. A lot of people get this wrong because they see the green. Like, oh, it's a green small body. That means bulls have more control. No. If I see a spinning top or if I see a candle formation looking like this, I'm not interested. Because look at the price. It's all over the place. No one has control. Now, if I look at number two and it's red, who has more control? Bulls or bears? No one. No one has more control. It's the same thing. They're neutral. No one has control, even though it's red. Even though the body's red, doesn't mean bears have more control. It's neutral. Why is it neutral? Because look at the wicks. Very, very long wicks. Very, very long wicks. The wicks itself are representing that bulls and bears are indecisive. That there's no one in control right now. They're both indecisive. So if you see this, be it red, be it green, whatever color it is, it doesn't matter. Because it matters about the wicks, it matters about the size of the body, exactly what we went over in the candlesticks in the previous lessons. Very, very important to understand. Does not matter what the color is. Spinning top is very similar to a doji. Once again, a doji would maybe look something like this, but a spinning top just says that the doji has a small body. The small body could be red or green, doesn't mean anything because the wicks still represent that no one is in control. No one is in control. Keep that in mind. Even if the body is red or green, doesn't matter. No one is in control, right? Next, we have something called the pin bar. So the pin bar has a long wick on one side. So if you notice the difference between this and the last pattern is the pin bar has a long wick on one side and the body is on the other side. In the other patterns, the body was kind of in the middle. It was kind of in the middle. In this situation, the body is primarily on the opposite end. This showcases a possible reversal. This is formed when prices are tested and or rejected, right? This is also known as the hammer, shooting star, hanging man, or the inverted hammer pattern. So if you guys have looked into patterns in the past, this basically means the same exact thing, right? Same exact thing, hammer, shooting star, same thing, just focus on pin board. They all go into the same concept, right? So you don't have to go and remember each one of these one by one, because that doesn't matter. The market doesn't follow each pattern. It follows price formation. It follows what's happening with price. So this is the only thing you need to know. Now, if you look at this one, who has more control? Bulls or bears? And number one, who has more control? Bulls or bears? Or are they indecisive? Right? So once again, in number one, is it bulls? Right? Is it bears? Or are they indecisive? The correct answer in number one is bulls. Bulls have more in control. Why? Because look at this. Bears step in and reject the price. Bulls come back in and they're like, nope, we're going to bring the price back up. This is too cheap. We're going to get aggressive. This is a very, very good deal. So we're going to step in and just start buying up the stock. They showcase their strength. So here, bulls are stronger, right? So think about this. Imagine this is support and you see this at a support level. This is showing that bulls stepped in. Bulls are getting strong, right? Now, let me ask you the same question again, but let's switch up something. Instead of making this green, let's make this body red. Let's say this is red, okay? And it looks something like that. Now, who is in more control? Is it the bulls? Is it the bears? Or is no one is in control? Think about that. We switched it from the green body to the red body. Are bulls more in control? Are bears more in control? Or is no one is in control? Now, the proper answer is bulls are still in more control. Bulls are still in more control, not bears. Do not get confused by the color of the body. A lot of people are too focused on the color of the body. Yes, the color of the body matters, but in this situation, look at the wick. This is the strength of the bulls, and this is the strength of the bears. A huge difference. Who is stronger? Bulls. Now, if this body was green, right, bulls would just have a little bit more control than the body being red. Very important to understand that. Now, let's flip over to the second one. Number two, who has more control? Bulls, bears, or no one? Who has more control? Bears. Why? Because they were able to drive the price down, right? This is how much they control, and obviously they control this much too. Bulls control maybe this small amount because they were able to bring the price up. So if you factor that in, you can notice right off the bat that, hey, bulls have a lot. Bears have a lot more control. Bears have extreme control over bulls in this situation. Even if this was green, the only thing it would mean is this is how much control bulls have, and then bears would just have this much control, which is still much, much more stronger. Now, pin bars, you'll see something like this, right? What's happening here? Stock is trying to break a critical level, keeps getting rejected, keeps getting rejected. Tries to break the support level, keeps getting rejected. Buyer stepping in, seller stepping in, seller stepping in. Here you can see buyers don't step in, breaks, retest, sells off, retest, and you can see by the wicks what is happening. The pin bars are showing that. The wicks are showing rejection on this side or rejection on this side. Buyers are stepping in. The moment that level breaks, that showcases that bears have now taken control. Now, if that happened on this side, where you saw a strong breakout and the candle looks strong, that would showcase bulls are now in control. Here's another example. You can see pin bar, buyer step in, buyer step in, buyer step in, buyer step in. And then boom, they get a little indecisive, bulls and bears. And then you can see bears take control and the price starts going down. All right. Now the next pattern we have is called the outside bar. This is a major reversal signal. This should be utilized on larger time frames such as a weekly, daily, or maybe sometimes the 4-hour, but primarily the weekly and the daily, right? This showcases that the existing trend has ended. This is also known as something called an engulfing pattern, right? So the way outside bars work is this is one bar. This is, let's say, Monday. Tuesday, the bar completely eats up the next day. Bar completely eats up the last day's price right there, right? Now, it looks something like this. It's called an engulfing pattern, right? So in engulfing patterns, let's say a stock is going on a downtrend. This day, let's say the stock opened at 10, closed at 9. Engulfing patterns need to gap down to make them stronger, and if they gap down and continue, there is an extreme high probability that the stock may continuously keep going higher. Now, the whole story behind this is, think about it. Let's say stock is on its way down, downtrend, 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 downtrend. You see a bullish engulfing pattern. Stock is at a major support level. Now, the story is, as the stock gaps down, bears have control. But the fact that it gaps down and bulls are still able to drive the price higher, that showcases their strength. And that indicates that there may be a possible reversal. But now think about something. We're not trading just off simple price action. There's context that has to be included. Is it on a trending direction? Is it hitting a critical level? Now, another thing to look into would be catalyst, news, sentiment, market direction. Let's say stock ABC is selling off because they got a lawsuit. Let's say the lawsuit gets cleared and everything is good now, and you see a bullish engulfing pattern. Boom, that's giving you an extreme high confirmation. Vice versa on a bearish engulfing pattern. Stock is on an uptrend. Instead of gapping down, the stock's price gaps up. Eats up the last candle. It doesn't have to eat up the wicks too. If it just eats up the body, that's totally fine. And if it eats that up, that just gives you a higher confirmation. Now, what I want you to keep in mind is it doesn't always have to gap up or down. Sometimes it'll open up here and just, kind of be relatively close to the opening price and continue. But don't perfectly look for these patterns and say, I need to find a bearish engulfing pattern to short, or I need to find a bullish engulfing pattern to buy, because they don't always work. But if you do see them with proper market context, and you look at all the quality factors, high volume, at a critical support level or resistance point, market sentiment looking good, company sentiment looking good, you could have a high probability trade. Another one we have is called a piercing pattern. Now, a piercing pattern is very similar to a bullish engulfing pattern, but the only difference is it doesn't eat the whole candle, right? In an engulfing pattern, it gaps down and it eats the whole candle. In this situation, it doesn't eat the whole candle, but once again, if it's at a critical level, if it's trending, if there's catalyst behind it, there is a high probability that this could also reverse. Vice versa on a bearish piercing pattern known as a dark cloud cover. Once again, the names don't matter. I don't care about the names, neither should you. The only thing you should understand is price formation. This means stocks going up, gaps up, bears take control, and this is also known as a gap play, which we'll go over in strategies. And then bears take control, and there's a high probability of the stock continuously going down or up depending on what pattern is presented. So here's an engulfing pattern. Now, if you look here, you can see engulfing pattern. Stock is on a downtrend, bearish investor sentiment. Price gaps away from previous day's close. See how it gaps away. And then as it gaps down, look at the green candle, eats the red candle, showcasing that bulls are taking control. As bulls take control, you can see there's a very high probability of the stock going up. Just to bring it up once again, do not just trade off this pattern. Make sure you are looking at market context. Make sure you are looking at news. A stock is not randomly going to go from 30 bucks all the way to 10 and then start reversing because there's a bullish engulfing pattern. There needs to be news. There needs to be catalyst behind this play. There needs to be some fuel to drive this higher. So please keep that in mind. Next, we have something called an inside bar. An inside bar is the opposite of the outside bar, right? Now, what happens in this, let's say a stock is on a downtrend. The next day, the stock's price stays in between the last candle. The next day, the stock's price stays in between the last candle. So this showcases that the existing trend might reverse or is slowing down, right? This should be utilized on larger time frames such as weekly, daily, or maybe a 4-hour, but primarily these two. Price gaps up or down and stays in the last candle's range. So in this situation, right, price gaps up, stays in this range. In this situation, price gaps down and stays in this range. This is also known as a Harami pattern. Like I said, there's a bunch of names out there, guys. We don't care about names. We only care about understanding what's happening. So I'll show you on what is happening here. So if you look right here, you can see expansion candles. Each candle makes a higher high and is going very, very high, right? It's showcasing a strong trend, a strong price formation. What happens right here? Stock gaps down, right? And shows that the market has contracted, right? That the market is slowing down. Now, when you see an inside bar or any pattern, you don't take on a trade right away. You wait for a confirmation. The confirmation here would be, okay, can the stock or will the stock break this level? If it breaks that level, that is now giving you a trade. And I'll show you an example of why that pattern is very, very important and why it needs to break a certain point, right? Here's another inside bar. So if you guys take a look here, you can see expansion candle, stock makes a huge move down, and boom, inside bar candlestick pattern shows that the market has contracted. And you can see for you to continue this play, stock kind of has to break that level and take the trade from there. This one, if you take a look, was a little bit more messy, right? It didn't perfectly go back up. The next day was a little choppy. There's no trade, no trade, no trade. This day, depending on volume and all the other factors, could be a trade, retested, and then continued. So depending on the play, it's never going to be clean, but just keep in mind that the trade should kick in if it can break this level. Sometimes it might have to fill the gap, like we went over gap fills. If you guys see right here, we have a gap. So in this situation, there wasn't a strong gap break, right? So you can see, so in this situation, instead of me taking the trade here, I would want it to break the gap and maybe take the trade there. So I think a more comfortable trade would be somewhere here, knowing the other factors. So that's why understanding the surrounding factors around the play, looking at the chart, if there's a gap, is it at a critical level, is very, very, very important. Now, if you look at one more example, inside bar, you can see stock goes on a downtrend, we get an inside bar right here. What this inside bar once again represents is that the stock may possibly, once again, possibly, right, possibly, not 100%, possibly go up. Only, remember, if it can break that point. So our trade entry would be there. If it can break that point, that's where our trade entry would kick in. If it doesn't kick in there and it breaks this point, then it is a continuation move where the stock took a break and it is continuing the sell-off. So you need to keep that in mind. So if you see this, do not say, okay, I see an inside bar, I'm going to buy. This stock is going to go up. No. Even if all the factors are right, I still want price to break above this level and be there and hold that level very, very strong. You can see price goes up, gets rejected. I still don't take the trade. I take the trade if it breaks this level. Now I short it. Instead of looking to be a buyer, I'm now shorting it. It broke the same level where buyers stepped in. I now take on the short position. Now, candlestick pattern keynotes, just to recap everything real quick. A candlestick pattern on its own is a very weak signal. So do not trade just a candlestick pattern. So don't go online and start remembering different other types of candlestick patterns and try to trade them, right? Candlestick patterns are awesome to use, but they should not be the first or only factor in your trading decision-making process. You need to look at other factors when you identify if you're going to buy, sell, whatever the case is. Look at other criterias. You need to look beyond the candlestick patterns and get market context before you make a trade, right? Do not jump into a trade once again by just looking at candlesticks. And I really stress on that a lot, because I know a lot of people, when they get in front of a screen and they have real money in their account and they see a candle, boom, they're like, I found this perfect candlestick pattern, I need to get in, no, look at the context, please. Instead of focusing on patterns, focus on formations. Don't go back and try to remember each name and say, this is a gravestone doji. No, names don't matter. Understand the formation and get a deeper understanding of price. Get a deeper understanding of why does this pattern mean it's going to go up? What does this candle mean? Why would this candle mean the stock's price is going to go up or down? What's the context? Is it going on a downtrend? Is the stock taking a break? What chart phase is it in? And all of these things, as I mentioned, get easier and easier as you look and practice more and more and study charts by being in front of your computer and practicing. And I promise, as you practice more and more, it's going to get a lot more easier.